Global equities started the week cautiously as semiconductor stocks extended losses on Monday while geopolitical and trade tensions intensified. Fresh US sanctions on Iran and the threat of secondary sanctions add uncertainty to the market today, particularly around what China will say about them. Meanwhile, US Treasury's potential support for bond buybacks could ease pressure on longer-term yields and support asset valuations, but also risks complicating the Fed's inflation fight. So unsurprisingly in this context, appetite for hard commodities returns. So welcome to Swissquote's daily market talk. It's Tuesday, 25th of August. I'm İpek Özkardeşkaya. We will talk about many important topics today, but before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So despite a retreat in oil prices on Monday, global equities made a timid start to the new week. The FTSE 100 index, which is heavy in energy and mining stocks, gained despite pressure on oil companies, while the technology-heavy US peers were hit by another wave of chip sell-off. VanEck Semiconductor ETF fell another 2.43% yesterday, and this ETF is now down by more than 18% since its June peak. Sentiment in Asia is better this morning, but the geopolitical and trade war headlines pop up everywhere right now, suggesting that the US relationship with the rest of the world may be just about to get worse, and that's going to have financial implications, obviously, for global equity and bond markets. Speaking of which, Besant yesterday announced heavy sanctions against Iran, but he also announced secondary sanctions for those who do business with Iran. Now, the US didn't mention directly the name of China, but China is one of Iran's biggest clients for its oil, and they had already made it very much clear indeed that the US sanctions, if they don't make sense according to the Chinese law, wouldn't be taken into account. So now everyone is waiting to see the collateral damages of a war that the US has reportedly limited means to continue fighting. Speaking of means, US Treasury Secretary Mr. Bessent made another important announcement yesterday. CNBC reported that the US Treasury could potentially tap its roughly $935 billion Treasury General account at the Federal Reserve to fund expanded bond buybacks that Mr. Bessent was talking about last week. That's not too bad. That means that the US Treasury would buy more of these longer dated US bonds from their cash account rather than on new and shorter term debt. Well, nearly $1 trillion gives the US Treasury a notable firepower, obviously, to ease longer term borrowing costs, while obviously it's not going to be spent on that only. But US 10 and 30-year yields reacted by falling yesterday to the news. They reversed course in Asia this morning, and I'm not really sure that in the longer term investors will be comfortable with that. But in the short run, this financial support from the US Treasury is positive for bond prices because it has potential to pull yields lower and support equity valuations. But on the other hand, keeping borrowing costs under pressure would also mean that the financial conditions in the US would be looser than what the Federal Reserve would like to tame and bring inflation back to the 2% policy target in the US. Therefore, if US yields remain subdued due to intervention from the US Treasury and not necessarily backed by fundamentals, well, it will be costly for both the US Treasury due to the Treasury's general account meltdown and to the people as well due to higher inflation. So obviously the best is still end this war in the Middle East to bring energy prices lower and also maybe rein in on the growing budget deficit of the US. Actions that have not yet made their way to the US administration's playbook. As such, and again, US Treasury throwing its full support behind the US bond market will continue to bring liquidity to the market, and that liquidity will have to go somewhere, and that will mathematically support valuations of risky assets. And it's exactly what the Fed's QE did since nearly 2 decades. It was sometimes criticized, but it did help bring liquidity to the market and support equity valuations. The thing is, the post-global financial crisis period was marked by low inflation in the US, but today, US inflation is running persistently above target, and inflation hits everyday goods and services prices, not only equity prices. As such, all eyes will be turning to the Federal Reserve to see how the Fed responds to the latest actions from the US Treasury Department that only make the inflation picture, the inflation outlook in the US more complicated. New chair Kevin Warsh will speak on Friday at Jackson Hole Symposium after the US reveals on Wednesday its latest PCE figures, the core PCE figure being the Fed's favorite gauge of inflation. And all that complexity in the inflation outlook and what's going on inside US is reflected in bullish price action in gold, but also in other hard commodities prices. Renewed appetite in gold despite the rising long-term US yields is striking indeed and sends a clear message to the market. Investors are moving back to the precious metal as 1. To hedge themselves against the US unclear fiscal plans and the lack of conviction of the US administration capacity to rein in on the US exploding debt when military expenses are also adding on the already heavy bills. 2. To hedge against inflation amid Fed's willingness or the possibility to fight inflation independently from the White House. And 3. Potential sell-off across global risk assets on worries about high valuations there, the massive AI spending, and the growing financing web has building around these companies that are involved in building the AI ecosystem, the so-called circularity. So last Friday, gold cleared an important technical resistance, the $45.30 per ounce level, which is both the 200-day moving average and the major 38.2% Fibonacci retracement on January to July retreat. The price of an ounce flirted with the $4,700 offers this morning in Asia before giving back part of gains. The question today is, will gold gather enough momentum to return above the $5,000 psychological mark sustainably? Well, the answer is possibly yes. There's a broad de-dollarization trade that's quietly building, or not so quietly building in the background, that is justified by global institutions' efforts to replace their US Treasury holdings by gold, while remains supportive of gold in the longer run. In the shorter run, it's always a bit more complicated because the overbought conditions of today could lead to downside corrections in the short run, giving hence the buying opportunities to long-term bulls. And zooming out, hard commodities other than gold are also having a moment since last week. Among them, Bitcoin rallied more than 30% since last week, and copper, which is one of my favorite industrial metals in this AI age, is also pushing higher with the positive momentum being backed by backwardation. That means that spot price is higher than its future prices, which in turn is backed by strong fundamentals today. Copper supply and inventory struggle to keep pace with strong demand growth driven by electrification and AI build-out. The supply remains tight, and the widening demand-supply gap makes traders willing to pay a large premium for copper now rather than copper delivered later. We even saw a big squeeze in London last week, remember. As such, the medium to long-term outlook for copper remains positive. The physical market, as I said, is tight. Demand continues to grow, while also the macroeconomic setup of the moment with rising inflation expectations everywhere in the world increases appetite for hard commodities. As such, any retreat that we might see in copper prices or copper miners' stock prices could eventually offer interesting dip buying opportunities for long-term investors to buy or to strengthen their existing long exposure to these metals and to these metal miners. Global ex-copper miners ETF, for example, rallied more than 215% between April 2025 to January of this year, and after an early year retreat is now back approaching its record high levels. Better yet, investors could also allocate capital to the more diversified range of mining complex to hedge against supply, geopolitical, and inflation risk via ETFs like S&P's GSCI Industrial Metals ETF, for example, that tracks 5 metals: aluminum, copper, zinc, nickel, and lead. Helps diversify the idiosyncratic risk around these metals, but also helps investors to play the longer-term macroeconomic game. So this is all for today. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, Good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.